Welcome to Subramani. What should be your strategy towards debt investing? Let me first put a caveat. I personally don't invest in debt funds anymore, not after March 2023 because of the taxation structure. So I invest in only in hybrid funds where the amount of equity could vary anything from 35 to 85. So I stopped investing in equity funds and stopped investing in debt funds because of the taxation. However, debt funds still make a lot of sense because you will pay tax only when you withdraw. So if you're a 30-year-old who is investing in a debt fund and you withdraw that money at 65, which means 35 years from now, so you're talking of 2058 for your withdrawal, it's a fantastic way to invest, simply because all you have lost is the impact of indexation. In the meanwhile, in the next 35 years, many things could change. In 1 year, if you make losses, you could withdraw and set it off against that capital loss, right? So all those things are still there. Indexation benefit is lost, which is very bad in the sense, for a retail investor, debt funds were almost giving a tax-free return. Now you will have to pay tax, but this was necessary. I'm not getting into the philosophy of that. So now what you should be doing is, don't look at just the liquid fund yields and say, oh, I'm liquid fund itself, I'm getting 6.5% or maybe even 7%. So why should I increase the duration in my portfolio? That's a good question to ask, but a wrong question to ask, because going forward, as the interest rates keep coming down, your liquid fund will go back to its 3%, 2% kind of yield. That's what it will yield. It is the current flavor which is giving you this 7%. It will not sustain. Whereas if you buy duration now, and by buying duration I mean, if your average duration now is 2-3 years, right? So suppose you've got some ultra short bond fund, you've got liquid fund and some short term income fund and a long term fund, your average duration would still be about 2.5 to 3 years. I am talking of increasing duration by 30-40 years, right? So there are such products, but I am not going to talk about them because I have not seen the portfolio, I have not seen the cost. I saw one portfolio which I expected to have a long duration, but it has 2-year duration. So I don't want to talk about these fund manager strategies, what they are doing. So I'm not talking about it, but yes, go and buy a long range fund which could be 30 years, maturing in 2045, maturing in 2055, kind of a fund which are there in the market as pure debt funds. And largely these are gilt funds. They will have an extremely insignificantly small portion of corporate debt, but then honestly, for getting a 30-year corporate bond is almost impossible. So largely these people don't want to take the risk. So therefore you should increase your duration. So increasing duration you can do by looking at each of your funds, or just going and buying one 30-year duration fund, because even if you put a reasonable sum of money there, your overall duration won't go up much, because most of your other funds would be in 2-3 year kind of duration. So why is this happening? One, first of all, the global growth story is not as bad as we thought it would be. America with higher interest rates is still able to grow for whatever reasons. I mean, they keep saying that Americans were saving the dole money which was sent to them during COVID. Actually, a lot of it got gambled away also, but some money must have found to some sensible use. I'm still worried about the credit card debt and the student debt in the US, but people don't seem to be worried about that. The balance sheets seem to be good. If corporate balance sheets don't seem to be very bad, they're sitting on a lot of cash. So the rise in interest rate is not impacting them. Second, they also feel that the mortgages are largely fixed. So even if you have mortgage which has been there for 5 years and you got another 20 years to go, the rate of interest is not changing much. So the mortgage payments are not hurting, but the real estate in US is also not doing too well. Having said that, will US have a soft landing, will it have a hard landing, or will it just not have any problem? Will it just go to a higher interest rate smoothly because the growth is being maintained? I don't know, but is there a worry that interest rates in the US will come down much earlier than what we thought it would? I'm not very sure, but honestly, if I'm adding duration to my portfolio, I wouldn't mind if interest rates stay higher for a longer period, right? Higher and longer, because it means I am postponing my capital gains in that fund, which is good because I will be getting a higher yield for some time, right? Today if I put and the current yield is 7.5-8%, I think it will come down to maybe 5%. The later that it comes down, the greater is the profit that I will make, because these are accrual funds. So funds are, the interest is getting accumulated there. So 3 years interest, let us assume that no interest rate changes for 3 years. Am I very early in the cycle? No, I am not, because my money is still growing at 7.5%, and after 3 years if it starts falling, then I will make capital gain, and in those 3 years I would have built a reasonable portfolio. If I put say 10 lakhs of rupees and I've got 7% return, which means I've got 70,000, so I've got 70 every year over 3 years, so it has suddenly become 12 lakhs, right? So that is one advantage of if it is longer and stronger, that's better. So therefore increase your duration, because world growth rate is increasing, led by US. US is not intimidated too much by the interest rate changes. If anything, the interest rate could get cut, because it is showing growth even on a higher interest rate. So maybe higher and longer, yes, but the cuts will come. Will the cuts come in 2024 in India? Maybe. In US, maybe it will take to end of 2024, but when the cuts come, you will make some capital gains also, right? India's story is of course being driven by the urban consumption. It is a good consumption story. The rural consumption is not so great. Monsoon has been a little erratic, but monsoon has not been bad. So once the monsoon, it is now, we'll have to worry only about the next monsoon. So the urban growth will sustain, and there will be more urbanization. So I think that is less to worry about. So your scooter sales, your motorcycle sales, car sales, television, all that will continue to happen. Your urban sales will happen. Your rural sales a little in question. What about inflation? Well, inflation is moderated. We were earlier worried about, onion prices went up, a lot of vegetable prices went up, and for whatever reasons, but they are now down back to normal levels. And also post monsoon during winter anyway, vegetable prices are not something to worry about. So inflation in India has been raising its heads once in a while, but more in political rhetoric, not in real life impact. There has been no great real life impact. You go to any place, it's crowded. People crib about higher oil prices, but the roads are full of SUVs. So I don't think that is something to worry about. The oil price hike will hurt, but 2-3 things are happening. One is people are using more electric vehicles, but far more importantly, our services exports are much greater than oil imports today. And again, today to worry about $100 oil is wrong, because our economy has grown substantially over the last say 7 years. Maybe the economy has doubled. So today, are we worried too much about the oil price hike? I don't think we need to. Capital market inflows are coming in a little trickle. It's not so great, but lack of opportunities other places, and the PLI scheme and the attraction of such a big market might just pull people in, and we are definitely going to see some kind of inflows. We are not worried so much about outflows. We may worry a little about stagnation, but we are not worried about outflows. So that is that. Are we worried about the rupee dollar exchange rate? I'm not too much worried, because the American rate of interest, if it is 4.5% and India is 7%, that gap will always remain, right? That's a more developed economy. So 2.5% interest gap is good, which means RBI is doing an extremely good job of managing the interest rates in the country, and which means they're managing inflation well. So inflation is not very intimidating. It is there, but not very intimidating, and I think we will be able to, RBI will be able to manage that. Only worry is in the 2024 election there will be a freebie race that could put some inflation, but I don't think that is something to worry too much about. Bank balance sheets are good, corporate balance sheets are good in India. I don't think that is something for us to worry. Low risk of fiscal slippage. I don't think fiscal slippage is something which we have to worry about. RBI is doing a good job, so that is not something to worry about. There is a lot more demand for money from the industry than what the banks have, so there seems to be a gap. However, that gap will be very well met by the mutual fund industry, in the sense that the mutual fund industry is collecting money not only in equity but also in balance advantage funds and multi-asset funds. All that money will go into debt market. So I don't see interest rates in India going up in a hurry, because banks have a shortage of money. Money will come from all these sources, right? Also, I find that the bottom of the pyramid lending is today being done by apps. Whatever it is, whether it is Navi, whether it is Paytm, there are very many apps. These are two names which came to my mind, and they are very happily lending at usurious rates to the lowest end of the pyramid, which could hit bank profitability. But I don't think there is much to worry about from a shortage of money point of view. From somewhere money will come and be met. I think interest rates will stay elevated for longer. RBI is likely to maintain an extended pause. I don't think the interest rates are coming down in a hurry, but like I said, if interest rates don't come down in a hurry, which means your capital gains are getting postponed, which is very good, because you will get a greater gain because of the fall in rate, because you would have accumulated more money. Should you accumulate money as a lump sum or as a SIP, I think both are okay. It's not that the market is going to be in some tearing hurry. If we are 7.25 in the gilt, we may go to 7.35, when you could be buying more. But I don't think there is much. I mean, are the interest rates going to 8? I don't think so. Maybe 7.25, 7.3, 7.35, maybe 7.4, but I don't think it is going much ahead, because a lot of money will come to the government if it increases the interest rate. So I don't think that is going to happen in a hurry. So I think you should add the duration to your portfolio. And I'm not commenting because some of the portfolios which I saw were not worth commenting. Thank you.